I'll just come out and say this. Before you take your pension, you need to slow down and ask some really tough questions. It's tempting just to sign the papers, take that monthly check and call it a day, especially after decades of hard work. But the truth, that one decision shapes the rest of your financial life. If you don't ask the right questions up front, you might lock yourself into choices you can't undo. Pensions feel simple and stable, but behind the scenes, they're full of trade-offs. What happens to the money if you pass away early? Does your monthly check keep up with the rate of inflation? Are you staying at a job longer than you need to just to earn a little bit more in that pension check, even if it is costing you time, health, or happiness? These aren't just financial questions. These are life questions. I think of my client, Sharon, a dedicated teacher who thought she had to work 2 more years just to max out her pension. But when we looked closer, those extra years wouldn't add much to her monthly check, and they were burning her out, and she was starting to fight some onerous health problems. She chose to retire earlier than planned, and she says it's the best decision she ever made. Her pension supports her just fine, and now she's got her life back. Now, I know some folks still think a pension means no worries, and I feel ya. But the smart ones, the happy retirees, they take a pause and ask the right questions first. So in this video, we're gonna walk through the 6 critical questions you need to ask before taking your pension. Let's get to it. Welcome to the Retirement Guide channel. My name's Darryl Rosen. My firm, SECURiMENT Wealth, helps people just like you plan for and hopefully enjoy retirement. Hopefully. Let's go back to Sharon, the teacher I mentioned a few seconds ago. Her story highlights why this first question is so important. Sharon had been teaching for over 30 years and was running on fumes at that point. The parents, the kids, the administrators, everyone was wearing her down. And like clockwork, every time we spoke, she'd say, just 2 more years and I'll max out my pension. It felt like the responsible thing to do, but I wasn't so sure. When we ran the numbers, things got interesting. Retiring at 62 would have locked in a pension of around $3,100 a month. If she stayed until 64, that bumped up to about $3,350 per month, a fairly modest increase of $250 or $3,000 a year. On paper, it looked like a reward, but we had to zoom out a bit. By staying, Sharon would have earned her regular teaching salary of $70,000 a year for 2 more years. Retiring early meant walking away from that and leaning on her investments a bit to fill that gap. So that was the real tension, not just more pension later, but less income now. Here's where it all clicked and came together for her. Her investments could easily cover the difference between her salary and that slightly reduced pension. More importantly, she realized she was sacrificing time she could not get back. Time with her grandkids, her garden, her health. So we asked the honest question, is the pension helping you or holding you? Sharon chose to retire at 62, and while she gave up that extra $250 a month in pension, she gained freedom, energy, and purpose, and her investments still intact and growing. Sometimes the smart move isn't about squeezing every dollar, it's about knowing when enough is enough. Just because your pension comes from one place, like a current or a past employer, doesn't mean it's your best or only option. This is where things get way more interesting. Some pensions lock you into fixed monthly payment for life. Others give you a choice. You can either take the annuity that they offer or roll out the lump sum to an outside insurance company that might offer better terms. Simply, it doesn't really matter who sends the check to you each month. We just want a company or entity that's reliable, and we want as much money as possible. Recently, I worked with a client named Ron who was offered a monthly pension from his employer at $2,800 for life. But we discovered he had the option to roll out a lump sum of $500,000. When we took that lump sum to a competitive insurance company, they offered a guaranteed lifetime annuity of $3,100 per month. Same safety, better income. For Ron, it was a no-brainer. It was a lot of security and much more cash flow. Another reason this warranted some examination was because of the survivor benefit. With a competitive insurer, we were able to get a 100% survivor benefit instead of a reduced one, which is typically what you see on a company type pension plan. We'll have more on the survivor benefit later. Here's a caveat, and please listen to this. It's super important as it relates with what you ultimately decide to do with this decision. Be very cautious of anyone who says, just take the lump sum and let us invest it for you. We can do better. Maybe they can, but maybe they can't. Maybe you see yourself as a mini Warren Buffett, able to consistently pick the right investments. Whatever the case, if you're giving up a sure thing for the hope of higher returns, you're trading certainty for risk. And in retirement, that's a very dangerous bet. So before you sign on the dotted line, ask, is this truly the best deal available to me? You might be able to do better, but only if you're asking the right questions and working with someone who's looking out for you, not just your assets. It's easy to assume that if your pension covers your needs now, you're really sort of set for life. But here's the problem. Most pensions are not inflation adjusted, which means your monthly check will stay the same year after year while the cost of living steadily rises around you. Let's do some quick math to drive this point home. If we say that your pension gives you about $4,000 a month today at 65, that might feel like it's enough. But if inflation averages just 3% a year, which is right around the historical average according to the Bureau of Labor Statistics, in 10 years, your purchasing power drops by a ton. That same $4,000 will feel more like $2,800. And if we fast forward 20 years, it's more like $2,100. If you're still receiving the same check amount, that could hurt. Recently, I've been working with a couple, James and Linda, who were comfortable in their first 5 years of retirement, but as their healthcare costs rose and travel got more expensive, they started dipping into savings just to keep their lifestyle intact, which is okay within reason, of course. Their pension hadn't changed, but the world around them had. We have to keep this balance, though, because inflation affects people differently depending on how and where they spend their money. According to the Bureau of Labor Statistics, households over age 65 spend a higher percentage on healthcare, about 13% of their budget, compared to younger households. Healthcare inflation tends to run hotter, as you likely know, closer to 5 to 6% annually. Meanwhile, retirees tend to spend less on things like transportation, clothing, and education, categories where prices may become stable or even decline. If your home is paid off and you don't travel that much and your lifestyle is simple, you may not feel the full brunt of inflation year after year. A fact borne out by the Employee Benefit Research Institute, where they find a retiree spending declining gradually over time, not increasing, especially after age 75. So no, you don't need to panic, but you do need to prepare. Inflation may not feel like a big threat every year, but over a 20 to 30 year retirement, it adds up. Here's a SECURiMENT tip. If your pension doesn't include a cost of living adjustment or a COLA, it's crucial to build in some flexibility through Social Security, timing, diversified investments, or part-time income early on to help you. Inflation is manageable, but only if you see it coming. And the bottom line is a fixed pension is a steady foundation, but it's not inflation-proof. Your retirement plan should grow with you, not shrink while your expenses climb. So ask the question now so you're not caught off guard later. This question is critical because it directly impacts the financial well-being of your loved ones after you're gone. When electing your pension benefits, you're often presented with choices that determine how or if your spouse will continue to receive income in the event of your passing. Consider Dave and Elena's situation. Dave at 65 was set to receive a pension of $3,800 a month under the single life option. Opting for a 100% joint and survivor benefit reduced this amount to $3,200. At first glance, the $600 a month in reduction seems quite substantial. However, Elena, she's 55, a full 10 years younger than Dave. And according to the SSA actuarial life table, the average life expectancy for a 65-year-old male is approximately 18 more years, bringing Dave to around 83. For a 55-year-old female, the average life expectancy is about 29 more years, bringing Elena to around 84. This means that if Dave were to pass away at a statistical life expectancy of 83, Elena would still have approximately 11 years ahead of her. Without the survivor benefit, she would lose the entire pension income, potentially facing financial hardship during those later years. By choosing the joint and survivor option, Dave ensures that Elena continues to receive $3,200 a month for the rest of her life, providing her with financial stability over 11 years. This amounts to approximately $422,000 in total benefits for Elena. Here's a SECURiMENT tip. While the reduced monthly payment may seem less appealing initially, it's essential to consider the long-term security of your spouse. Opting for survivor benefits can be a prudent decision, especially when there's a significant age difference. It ensures that your partner isn't left without support, aligning with the primary purpose of a pension to provide lasting financial security. The bottom line, when evaluating pension options, it's not just about maximizing your monthly income. It's about safeguarding that asset or protecting your loved one's future. Carefully assess the survivor benefit options and consider how they align with your family's needs and life expectancies. Here's something that surprises a lot of new retirees. Your pension is fully taxable as ordinary income. In other words, every dollar that lands in your bank account is going to count towards your total income for that taxable year, just like when you were working. And once you start stacking these other income sources on top, like your Social Security or investment withdrawals, required minimum distributions, part-time work, what happens is your tax bracket can quietly creep higher than you ever expected, almost like under the cover of darkness. Let's walk through an example. Let's say your pension pays you, call it $3,500 a month or $42K a year. And so that might land you in a moderate tax bracket, but once you start to add in $24K for Social Security or $10K for required minimum distributions, over time, and all of a sudden you're reporting a lot more income, significantly more income than you expected. That could bump you into a higher tax bracket, and depending on your state, you might now be liable for state income taxes. You could owe a lot more. The mechanics of how Social Security is taxed, that's a topic for another video, but here's the headline for you, the breaking news. Your pension increases your taxable income, and that alone can cause ripple effects that catch a lot of people off guard, including having their Social Security taxed. I had a client, Carla, who didn't realize how well her income sources would interact. She was quite surprised when I explained this to her. Her first year in retirement, she owed nearly double what she expected she would. It was a real eye-opener. So here's a SECURiMENT tip. You don't just need a withdrawal plan. You need a tax strategy plan, a way to save taxes in retirement. Questions: can you spread income over multiple years? Are Roth conversions worth considering in your neck of the woods? Should you withhold more upfront from distributions to avoid a nasty surprise in April? Pensions bring stability, but they also bring tax exposure. So before you start enjoying that steady check, right, running to the mailbox, as it were, make sure you've thought through how it fits into the whole picture, because in retirement, it's not just about what you earn, it's about what you keep. Does your pension exist in a vacuum? Look, it's easy to look at your pension in isolation. People do it all the time. After all, it's the one thing that feels locked in, a guaranteed monthly check, something you can count on that you've earned. But here's kind of a brutal truth. Your pension isn't a plan. It's a piece of a plan. And I've seen this happen so many times, where somebody builds their entire retirement strategy around their pension and forgets to consider how it interacts with just about everything else: taxes, Social Security, health care, costs in retirement, the market fluctuations that go on, especially like right now, even lifestyle goals. That kind of tunnel vision can leave you either overconfident or underprepared. Take Michael, a retired engineer. He had a generous pension, over $5,000 a month, and he figured, well, that's plenty of money. But he hadn't considered that his wife had no pension. He had no survivor benefit on his pension. Their Social Security timing was a bit off, and he never factored in Medicare premiums or long-term care, those costs. By the time he came to me, his financial life was stable. It was certainly stable, but it was far from optimized, and he wasn't unable to spend more money when he was younger and healthier. Here's a SECURiMENT tip. The smartest retirees see their pension as part of the orchestra, not just the whole performance. It should harmonize, to continue this analogy, with your investments, your income needs, and your tax situation, your long-term goals. Otherwise, you may end up with a solid paycheck, but a retirement that just doesn't quite work out the way you want it. The bottom line, your pension does not exist in a vacuum. It's a powerful tool, but only when it's integrated into a bigger, well thought out plan. The goal isn't just income. The goal is freedom, flexibility, peace of mind. And that comes from seeing the whole picture, not just one piece of it. If you like this video, you might like this one and this one. And thank you so much for watching.